Why Ethereum name service is seeing a spike in domain registrations. The registrations came out on the back of a record-breaking ENS sale, a research firm pointed out. Ethereum name service registrations spiked this week as prominent addresses sold for hundreds of Ether, sparking retail interest. ENS is a decentralized domain name protocol that runs atop the Ethereum network. It provides users with an easily readable names such as abc.eth instead of a complex long-form alphanumeric address for their crypto wallets. Similar to the way domain name service or system substitutes memorable names such as coindesk.com for websites and numeric internet protocol addresses. Some ENS buyers treat the names as investments, purchasing popular and common names and selling them for a profit. Research firm Delphi Digital said in a note this week. Last week, 000.eth was sold for a record 300 Ethereum, fueling interest in three-digit ENS names as traders tried to capitalize on the hype, Delphi Digital added. Daily ENS registrations also spiked, reaching over 30,000 new addresses on July 4th and over 20,000 on July 7th. This followed a lean period in late May and early June when registrations ranged between 3,000 and 5,000 a day. Some analysts noted that ENS addresses were among the most popular in liquid assets trading on NFT marketplace OpenSea. Quote, the interest we are seeing in ENS is partly driven by the fact that it's one of the very few pure true utility NFTs that are visible, widely known, liquid and traded on OpenSea, said Anderson McCutcheon, CEO of Chains in a Telegram message. The difference in value is also less subjective, as an address like chains.eth is objectively more valuable than ASD1 ASDG3.eth, he said. The fundamentals and value that ENS addresses are far more certain than any other opportunities for retail crypto investors. Jeff May, Chief Marketing Officer at ChainUp, said the uptick in shorter domain name registrations could be linked to NFT investors preferring the shorter tags due to a presumably higher value. Other market observers said lower Ether and gas prices also incentivize market participants to purchase and trade ENS addresses. ETH gas prices are lower during this bear market environment, said Jisoo Park, founder at Suho. There we go. This poses the perfect opportunity for investors to register ENS domains at scale, as the primary cost of doing so is the ETH gas fee. As the gas fee is decreased significantly, investors are highly incentivized to claim and trade ENS domains during this window, Park said. This isn't dissimilar to what was happening with traditional domain names and people purchasing them and then selling them for more money to companies in the past. So this is a really interesting one. I think it does have a lot of merit to it. If you guys would like a guide on purchasing ENS names and everything, let me know in the comment section below. And we have more Celsius news. Tether discloses Celsius loan liquidation process. And this is coming from the Tether blog. So you know that, I guess it's on point. Tether has never and will never put the integrity of its reserves at risk. This has been proven time and time again, not only by its ability to never refuse a redemption, but also in the absolute transparency of its reserves. While Tether's portfolio does include an investment in Celsius representing a minimal part of its shareholders' equity, there is no correlation between this investment and Tether's own reserves or stability. The Tether loan that was taken out by Celsius was an over-collateralized loan denominated in Bitcoin. And the decision to liquidate the collateral to cover the loan was a part of the original terms of the agreement between the two entities and reconfirmed in writing before the start of the liquidation event. This process was carried out in a way to minimize as much as possible any impact on the markets, and in fact, once the loan was covered, Tether returned the remaining part to Celsius as per its agreement. Celsius' position has been liquidated with no losses to Tether. Tether has developed a set risk metrics and risk measurement processes, which allow the investment and financial teams to evaluate the risk of any of the company's financial interactions. Tether's risk culture demonstrates an understanding of both the business of lending and takes into account the regulatory landscape in order to achieve and maintain its business objectives. Recent crypto market history has shown and should teach us that while the media, critics, and community were wrongly fixated on Tether, I agree, other lenders, including notable names in the space, were blatantly providing lending facilities with nearly zero collateral. I agree. This goes against the strict regulatory practice that the industry has set as a standard. Critics who make claims of Tether's inconsistencies clearly have no understanding of how lending, borrowing, and risk management work. And it's, they called it, they got out in time, and they managed that risk pretty good. It doesn't bode well for Celsius, obviously, but for the crypto market as a whole, especially if we take into account stable coins and their impact on the market, it's looking pretty good because Tether's the big dog, right? Tether's the number one. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.